In this presentation, we will continue on with our proprietorship comprehensive problem, moving on to the adjusting entries. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So we're currently in the adjusting entries tab. Before we start with the first adjusting entry, which will be for insurance expense, let's take a look at where we are at and how we got here, where we will be working, what the worksheet will look like. So we are in the adjusting entries tab. If we go back to the journals entry tab, just to take a look at where we ended last time, we entered all of our transactions. We entered all of our transactions into the general journal over here for the entire month. This is where most of the activity happens for an accounting department. This is us recording the data. And we've posted those to the GL. We used the GL to create the trial balance. So now what we're going to do is fixing a few things or adjusting a few things. We call them adjusting entries at the end of the time period, the month or the year, in this case, the end of the month of January, in order to make things as close to an accrual basis as possible so that we can use these numbers to create financial statements. That's kind of like our goal, of course, the financial statement creation. So if we go back to the adjusting entries tab here, all we're doing is taking, by the way, this trial balance numbers, go into the adjusting entries tab, and that's what we're going to be working with. We're going to work with this in a worksheet format here, however, rather than keep on working on it in the same format we had before with a GL. Why? Because the worksheet, when we work with these timing differences, will give us a good idea of exactly what we're doing with these journal entries. It'll give us the beginning balance and our adjustments, so we can see if we make some errors or if we want to figure out if it's doing what we want it to do. It's easiest for us to see it in worksheet format, and that's what we're going to do. So what does the worksheet do then? It's just going to take the same trial balance we picked up before, called a trial balance, and now we're just going to give it a new name called unadjusted, not adjusted. We haven't adjusted it yet. And so notice that's just kind of a made-up name. They're all just trial balances, but we're going to call it whatever name in accordance to where it is basically in the process. So this is our numbers we've left off with before. Then we're going to have our adjusting entries. We're just going to report them or record them or post them to this middle column rather than to the GL. And then the ending balance will just be the sum up of those activities. And that'll give us a really quick view of what is going on. Now, the reason this column works well here and doesn't work well in normal types of situations when normal entries are entered is because like if we've adjusted something for, say, supplies, and we only had one entry to adjust it, this worksheet is great because it shows us where we started, the adjustment, and where we end. If, however, we have 100 transactions, then this one cell is not going to be able to handle that many transactions, not going to give us the detail we need for the transactions, so that it's not effective there. So that means during the normal journal entries, we need a GL to give the detail. If we only have 5 to 20 transactions, this worksheet is great. Now note also that the worksheet only has 3 columns here, and that's because we have the debits positive, credits negative, which again I'll argue that that's way better than, say, having 6 columns, which we would need if we had a debit and credit column here, a debit and credit column here, a debit and credit column here. A sum function summing up these 2 cells is much more simplified and easier to use than if we had to add the debit minus the credit plus the debit minus the credit, have a complicated formula over here. So there's just another, if you see, in other words, a worksheet like this in some textbooks, it might be massively more complicated simply because of, not optimizing the debits and credits in a format which I will argue would be much easier, especially if using Excel and trying to use formulas to simplify the process. Okay, so that's what we're going to start with, and now we're just going to do our adjusting entries. In terms of adjusting entries, note that we have normal rules for adjusting entries. Those being, cash will not be affected. We'll have one balance sheet account, or more specifically, one account that will be an asset other than cash and a liability. And we'll have one income statement account, revenue or expense account. In other words, one account above the blue equity line that's not cash, and one account below the blue equity line that's going to be revenue or expenses. We also know that revenue and expenses only go up, and therefore once we know which account down here we deal with, it'll go up. And so we'll know which direction it goes, and we'll know what happens to the other account. just by it being going the other way. So we're going to be able to do a lot of this without knowing what's going on at first, and then we'll decide what's going on. So we'll apply the rules first, figure out what happens, and then think more about it just in terms of theory and why we're doing this after that. Also note that adjusting entries are not errors. These are not problems. We didn't make an error in the journal entries and now having to fix them. These are things that we planned within the process. So these are planned things that we have to do no matter how well the adjusting department did. If, however, there are errors that were made in the adjusting department or the normal accounting department that we may pick them up in the adjusting department. And when we do so, we may have to do something at this point like adjust cash or have a journal entry that's going to deal with just balance sheet accounts or something like that, or just income statement accounts. Like we find out that something was posted to utilities when it should have been posted to the telephone expense. We may do those types of adjustments here, but those aren't really adjusting entries. Those are fixing errors that we happen to do at the same point in time that we are making the adjusting entries. So keep that distinction in your mind separate, because that'll help you to determine what's part of the normal process, what's part of just accounting process, and what's part of fixing an error type of thing. So adjusting entries are part of the normal process. Okay, so the first one's going to have to do with insurance. So let's go through our rules. We're going to have one balance sheet account above the blue line dealing with insurance other than cash. It's not going to be tricky. It's going to be, let's see, how about prepaid insurance? So it'll typically say the name of what we're working with in there. I'm going to click on this and make it yellow to indicate that we're going to deal with this account. We'll do the same thing. There's going to be one account on the income statement, revenue or expenses, dealing with insurance. And again, if we just have a trial balance and we look through it, it's typically self-explanatory where we have, insurance expense. That's going to be the one we're working with here. So I'm going to right click and make that yellow. And so these are the two accounts we'll be dealing with. We know that the income statement accounts only go in one direction. They only go up. We know that insurance expense is an expense. All expense accounts have debit balances. They only go up. Therefore, we will do the same thing to it, another debit. So I'm just going to copy the insurance expense. We'll put that up top. That'll be our debit. Right click and paste 1, 2, 3. Also note that these transactions always happen at the end of the month. So we're trying to make things right as of a cutoff date, sometimes called the date that we're going to make the financial statements, January 31st in this case. So I'm not going to put the amount yet. We don't really know the amount, but we know we're going to debit it. And we know that if this is the other account that we're going to be dealing with, and there's only two of them, this must be the one we're going to credit. So I'm going to say, this must be the credit, right click and copy. Put that on the bottom, C6, right click and paste 1, 2, 3. I'm going to indent that, probably done for you already by going Home tab, Alignment, Increase Indenting. So again, we can know all that without really knowing what's going on. Now let's decide and talk more about what's going on. Now, these type of adjusting entries, they're always going to kind of continue a story that happened over here, meaning the question is, where did this number come from and why are we adjusting it? Where did this number come from? Well, we just kind of have to think about that and say, well, that must have debited prepaid insurance. We probably credited cash. We probably paid money. Cash went down and we debited the prepaid insurance, increasing prepaid insurance. Why didn't we just debit insurance expense? Because we hadn't yet consumed it yet. So what we're really doing now is we're saying this was part of something that we hadn't yet consumed, and now deciding how much of it we have consumed so that we can record the related expense in accordance with what we have used, not with what we have paid. So this was prepaid because we paid for it but had not yet consumed it. Now we're trying to determine how much was consumed. So we're going to say that there was 1 month has been consumed. So remember when we paid for this, if you'll recall, we bought this for 12 months. So it was $12,000 for 12 months worth of insurance. Now 1 month has passed, and so we're going to assume that this was the entire month of January was covered. We're not going to have a half a month. So if we had 12 months were paid for and 1 month has passed, then of course we're just going to divide by 12, and that means $1,000 worth of insurance was consumed. So I'll do that same calculation here. We're in D5. We're going to say this equals $12,000 for 12 months of insurance we paid divided by 12 months for 1 month that has been consumed, or $1,000 worth of insurance. Then we're going to credit for the same amount with our little formula. This equals negative of that. And there's our transaction. Let's record this to our worksheet and see if it does what we expect it to do. What do we expect it to do? We expect prepaid insurance to go down from 12 months to 11 months, or which would be 11,000. So 11,000 left. We expect the expense to go up for 1 month, 1,000 from 0 to 1,000, and that'll bring net income down. So we're going to record insurance expense, here it is, to the middle column instead of to the GL. We're going to be down here in cell I-22, where we say equals, scrolling up just a bit and pointing to that 1,000. I'm going to scroll down so we can see it, and then when I hit enter, this should go up by 1,000, bring us out of balance by 1,000, and bring net income down by 1,000. So there we have it. Expense goes up, out of balance, net income goes down. Net income was income minus expenses, revenue, credit, minus the debits. This is income, not a loss. Credits beating debits. It went down in the debit direction by 18,600. This, by the way, is typical when we do the adjusted entries. It's often, when people don't understand the adjusted entries, it's often bad news when we have to record them because it often brings the net income down as we do so. There are some that will bring revenue up, and we'll take a look at those as well, but oftentimes it'll bring net income down from where we originally had it as we recognize most of these, which will be related to expenses. Okay, so then the other side is going to go to prepaid insurance. Here it is on our worksheet. We're in cell I9 where we say equals, point to the 1,000. That's going to bring the 12,000 down by 1,000 to 11,000. So there's our transaction. That's going to put us back in balance, and net income went down. What's left in prepaid insurance? 11 months. 1,000 times 11 is still there, which we will consume each month until the 12-month policy has expired or has been used up. For more accounting information and accounting courses, visit our website at accountinginstruction.info.